Hi, and welcome to today's panel discussion where we'll answer the question, what are family offices and endowments? And my name is Anne-Marie Flurby, and I will be moderating today's discussion. And in addition to my day job as co-head of marketable assets and McKenna Capital, I'm also one of the co-founders of Gain alongside one of our panelists, Tilly Franklin. And I really couldn't be more excited to be talking about today's topic. And with that, I wanted to say a huge thank you to our panelists, Tilly, Jane Simpson, and Michael Buckman. Thank you all so much for joining today. And to get the conversation started, I'd love to ask you all to briefly introduce yourselves and describe a little bit about what you do, give some background to your career so far, and how you got to where you are today. So Tilly, I've worked with you for a very long time now. I'd love to start with you. Maybe you could just tell us a little bit about what you do, what did you study at university, and talk about your journey into investment management.
Sure. Thank you so much for that introduction, Anne-Marie. It's a pleasure to be here. So, yes, I'm Tilly Franklin, and my role is the Chief Investment Officer at the Cambridge University Endowment Fund. And I'll explain what that is in a minute. But first of all, I just want to tell you a bit about myself. So I studied English literature at university. So I'm living proof that you don't need to study finance or a technical subject in order to become an investor if that's a career that piques your interest. And I certainly didn't even know what investing was when I was at university, or that one could pursue a career doing it. So my first investment role I took when I was about 27. So I had numerous other roles ahead of that in consulting and business. So things that were tangentially related and gave me some relevant experience that came into investing a little bit later on. So jumping forward to today, what I do at Cambridge University is essentially oversee a significant multi-billion pound pool of investment assets that the university owns. And we have a small team managing those investments with the objective of both growing the university's capital over the long term, but also producing a reliable income stream and that the university uses for its purposes, whether that's offering professorships or scholarships to students and so on. We have a very broad investment mandate. It's very international. And I think one important thing to say is that we are not directly choosing whether to invest in one particular share or one particular bond, but we're actually choosing fund managers who are each experts in a particular field of investment, and then backing them with our capital to fulfill our objectives. So I'm sure we'll talk a bit more about what that means, but I'll stop there.
That's great. Yeah, thanks, Tilly. And we'll definitely dive into what it means, what you do in terms of portfolio construction in a little bit. Michael, over to you. It'd be great to hear a little bit about what you do. You actually work at a foundation. I should have said it's family offices, foundations, and endowments. You work at a foundation. Maybe you can tell a little bit about your background and how you got to where you are today.
Yeah, definitely. It's a pleasure to be here. Thank you for hosting me. I am feeling a little bit out of place as I believe I'm the one with the accent here. As you will likely surmise, for those watching, am located in Los Angeles, California, over in the States. I work for the Conrad and Hilton Foundation. I'll pause and get to that in a moment. But my academic journey, unlike Tilly's, I did have more of a technical business-oriented background. I went to the Wharton School for undergrad and also pursued a JD MBA at the Wharton School in University of Pennsylvania. And so that was my background. Always had an interest in finance and investing, although I thought I was going to pursue a career in real estate. And that's what my internships were in, and that's what my career trajectory was headed towards. I wrapped up some of my studies during the global financial crisis and found myself looking for alternative opportunities in a very challenging environment, and was fortunate enough to come across an opportunity at the Hilton Foundation that was just building out its investment team function. And that was 15 years ago. And it's proven to be a very rewarding and enriching and fulfilling career thus far, and hopefully for many more years in the future. So a bit about the foundation broadly, and we'll get into more detail, I'm sure, later. The Conrad Hilton Foundation was set up by Conrad Hilton, who founded the Hilton hotel business. And that was the business that generated his wealth, as well as his son, Barron Hilton's wealth. And what they did in a very philanthropic way was donate over 99% of the family's wealth to the charitable foundation. The charitable foundation is set up to exist in perpetuity, so to continue to support philanthropic efforts as directed by the family and the board of directors. It is distinct from a family office in that it is no longer the family's personal property, but rather it exists to fulfill the mission of helping disadvantaged populations across the globe. So that spans from child development in Africa to homelessness projects here in the US to Catholic Sisters across the globe. And our team, which is also like Tilly, a relatively small team that outsources the fund management to various fund managers across the globe. Our job is to manage the $7 billion asset pool to generate returns to be able to fund the foundation's operations and grant activities.
That's great and really, really interesting. And I'm really keen to dive into that in just a couple of minutes in terms of how you're set up and what your purpose is. So that's great introduction, Michael. Thank you so much. Jane, over to you. How about just a little bit of background? I think you also come from a non-traditional background for investment management. Maybe you can talk a little bit about that.
And I confess that when I was at university, it wasn't my dream to work in investment management either. So if you're watching this, you're already well ahead of me in terms of thinking about your career. I studied physics at university because I loved it, but quite quickly realized that a career in physics wasn't for me. And I had a sort of generalist career. When I left university, I worked in consulting for a bit and then pivoted to work in private equity. And then from there to where I am today. So today I work at Wayborn, which is the family office of James Dyson.
That's great. That's super. Thanks so much. I love that there's not like a consensus in terms of backgrounds, and we can also talk about that a little bit later on when we talk about advice for people who might be interested in finding out a little bit more interested in investment management. Before we get there, though, I'd love to talk a bit more about what the family offices and endowments are and how you're set up. And so, Jane, maybe we start with you in terms of what is a family office and how does it invest?
Yeah, that's a good question. And I think, Tilly will like the quote, it's a truth universally acknowledged that every family office is different, right? They really are, essentially what a family office is a way for a very wealthy individual or family to run their finances exactly the way they want them to be run, a very bespoke way. And because every family is different, so every family office is different as well. And some people want a family office that's going to help with every aspect of their life, from being almost a concierge service. It's going to help them run their properties, hire personal staff, and others will hire a sort of specialist team to run their financial investment portfolio. And even the family offices that go down that specialist route can end up with really different portfolios. So you might have someone who's an entrepreneur, maybe they've made their money in retail or fashion, and so they really believe, rightly, that they know quite a lot about that industry. So they want to build a portfolio that reflects their passions, and they invest in fashion businesses where they can be directly involved. And they might take a direct seat on a board and be really directly involved in those businesses. Other family offices, and Wayborn falls into that category, are much more like the endowment style that Tilly and Michael have described, where you build a portfolio that reflects what the objectives of the family are. In terms of, so for our family office, our job is to preserve and grow the wealth of the family over the very long term. So we end up designing a financial portfolio that will do that job for the family. So similarly, we're not stock pickers. We're not going out and buying shares in Apple. We're finding managers who will do the right job in the portfolio to deliver that objective for the family.
Really, really interesting. And you've spoken a little bit about how Wayborn, this is set up to preserve and grow the wealth of the family, which is aligned with Tilly's mission at the endowment at Cambridge, which is to preserve and grow the wealth, so to speak, of the endowment. It's a bit different though with Michael. Michael, and you mentioned that the Hilton Foundation is set up to basically to give money away. So can you talk a little bit about how you're set up and that different purpose and how it's maybe how that maybe informs your investment process?
Yeah, I think the way that the foundation is set up may be more akin to the university endowment that Tilly is managing, but we'll explore that and pull at that thread. U.S. foundations have some specific guidelines and requirements from a regulatory perspective, and so we, as a foundation, pay out 5% of our assets a year. That's a requirement. It's a minimum. Some foundations elect to pay out more. There are some foundations that exist where the donors, much like Jane, if a family elects to donate their wealth to a foundation, may have different aspirations or goals for the way that foundation is going to function. There are some individuals who are trying to spend all their money before their passing, during their lifetime. There are some that will put a time limit, X years after my passing. And then there are other foundations like ours, which are set up to exist in perpetuity. So while we pay out 5% a year of assets as part of our charitable enterprise and goals in addressing the issues that the foundation funds, the investment team's goal is to earn back essentially that 5% plus inflation on top of that. So if you think about 5% plus sort of 3% long-term inflation, it's been higher in recent years, but over the long term, the goal is to really generate a very long-term return stream of that, call it 8%, to maintain the purchasing power of the foundation and its impact in the future. It's a kind of this tension of, are we serving those in need today across the globe and disadvantaged populations, or are we trying to address problems or solve problems that require a long-term mindset over the long term? And so really that's what the foundation's investment team is there to do, is to be able to perpetuate the good work that our colleagues on the philanthropic side do. I don't get the great distinct pleasure of getting to give away the money, have to try and kind of earn a return to be able to continue doing that. And the better we do at our jobs, and if we're able to exceed that target return, the more capital there'll be in the foundation's asset pool to be able to give out even additional grants beyond that. And obviously, if unfortunately we fall short, that would mean sort of less good being able to be done in the world.
Yeah, really interesting. And Jane and Michael, you both described a very long-term investment horizon. Tilly, you've worked both at a family office in your previous career and now at an endowment. Can you just compare and contrast what you're doing at Cambridge with what Jane and Michael are doing? Are there similarities? Are there differences? Tell us a little bit about how the construct at the endowment. Oh, you're on mute, Tilly.
Oh, rookie error, 4 years into Zoom life. There probably are more similarities than there are differences. And I used to work for a family office, as you noted, and I remember the principal there saying that his investment time horizon was 500 years. It's actually really hard to have an investment time horizon of that long as an individual, but I guess maybe the difference at Cambridge is that Cambridge has been around for over 800 years, so it's potentially even longer than that. So clearly there's a huge incentive to, be a good steward and not be the person who sort of blew up the endowment after a sort of 800-year history of the university's sort of global academic status. But I think perhaps the difference, maybe less so on the time horizon or the high-level investment approach, but more in terms of our stakeholders and who we sort of are accountable to at the end of the day, because clearly there are many, many people who have a vested interest in what we do and the returns that we generate and how we go about doing that, not just our boards. We have a very very rigorous oversight structure, but also, of course, students, academics, administrative staff at the university, alumni, donors, future students. So it's quite a complex stakeholder structure from that perspective. I think that's probably the most significant difference, I would say.
Yeah, really, really interesting. I think you've all described an investment process where it's, you've talked about investing through third parties. And I'd love to have you unpick that a little bit more and maybe just talk a little bit about that asset allocation of the funds that you're working on. So maybe Jane, I could start with you. You referenced that you do you do investing through third parties. Can you describe what that means and how that might contrast with what our audience might have heard of outside of this panel?
I think at its core, what it means is that instead of you going out and trying to find the best possible investment opportunity in terms of a stock or a bond or a property, you find the very best expert you can in that area and back them to do a good job. So if you think about real estate, maybe that's a kind of an easy place to get your head around. You know, if you're sitting in London as I am, how would I find the best real estate assets to invest in Miami? It's going to be a lot better to find someone who's on the ground there, who knows that market, who knows every street and every building. And that's the person that we need to find to back. And it's the same with every part of the portfolio, whether it's listed equities or bonds or private equity or infrastructure. Finding real true experts who are fantastic at what they're doing, have a demonstrable track record and a repeatable approach to what they're doing. So you can have confidence they'll be able to go out and do it all over again.
Yeah, great. And that concept of finding the best expert in a particular asset class it really resonates across, I think, all three of you. Tilly, in your introductory remarks, though, you talked about that you invest internationally, and maybe you could just bring Jane's line of conversation in and tie that together with international investing and what kind of asset classes you might be looking at.
Sure. Well, maybe it's worth just zooming out a little bit to sort of start tackling that question and talk a little about asset allocation. So what do we mean by asset allocation? I think we're trying to build a portfolio of investments that essentially complement one another, that where essentially the whole is perhaps greater than the sum of the parts. And the different investment types that we have exposure to aren't all going to behave in the same way at the same time. So if one thing sort of deteriorating for some reason, whether it's to do with macroeconomics or particular types of companies, another thing in the portfolio is going to be doing really well, so that we can sort of manage the volatility of our overall performance in that way. So that's how we think about the very high level construction of the portfolio and what different investment types we'd like to have exposure to. So there's a top-down element to it. And then there's also, of course, a bottom-up element as well, which is much more similar to what Jane was talking about going out and finding the best, or what we think and believe to be the best investment manager or the best specialist is in each of those different types of investments. And I think a lot of people might believe that we spend an awful lot of time thinking about the top-down portfolio construction, and we do obviously take that very seriously, but actually the vast majority of our time is spent looking for that needle in a haystack, which is the sort of manager who's going to be a great partner to the endowment and to deliver exceptional investment performance over a long period of time.
And what you do is entirely indirect. So through these third-party managers, Tilly, is that correct?
Yes, almost entirely. And sometimes we'll buy an index, like, for example, we might buy the S&P 500 if we felt we hadn't got enough exposure to the US and we couldn't find a suitable manager in the period of time. But that's really more of an exception than the kind of bread and butter of what we do.
Yeah, okay. But like referencing to what Jane was saying, you wouldn't necessarily go and buy a hotel in Miami. You would do it through a third-party manager.
Yes, if that was something that we were targeting, for sure.
Yep. Michael, how does that compare to the Hilton Foundation in terms of that direct versus indirect exposure? And maybe you can also bring in the concept of domestic. You're based in the US, you know, in terms of domestic versus international exposure in your portfolio.
Yeah, our approach really is in line with what Tilly and Jane have outlined. We are not direct investors, and we'll get to perhaps the career part at the end, but someone who's grown up their entire life and starting in high school had a portfolio and they love picking stocks, and they love that daily feedback of the market, just given the long term that we've all referenced already in terms of the horizon we invest, and given that we don't do direct investing. This is very distinct from that, and a different cadence and sort of a different thought process. We too start our sort of portfolio building with an asset allocation. While we're based here in the United States, we also have a global portfolio, and so about a third to half of our assets are invested internationally. We will invest in both public equity managers as well as private equity managers. So public equity managers would be managers that trade stocks, that buy stocks on our behalf in a fund, either US focused. We have managers that are located and focus on European equity markets, Japanese equity markets, Latin America, China, India. So really a global equities portfolio. And then likewise, private equity, those managers focus on investing in companies that are not publicly traded, that you couldn't go into your Robinhood or E-Trade or account and buy on your own. And so those are range from venture capital, so very early stage investments in private companies, to larger private companies, to real estate. As Jane referenced, a hotel in Miami is likely a private investment through a private fund. And we'll construct an asset allocation where we have target allocations to each of those asset classes. And then we too will go out and try and identify and partner with fund managers, sometimes alongside investors like Tilly or Jane, as we may come to the same conclusion and identify the same manager or distinct ones. And that's really what we spend the bulk of our time doing, but very intentionally on a global basis to try and capture some of those benefits of diversification that Tilly referenced, not putting all our eggs in the proverbial one basket, but really trying to have diversification across the portfolio that allows it to compound and perform over various market cycles.
That's great. And actually it segues really, really nicely into like the next part of the conversation that I wanted to move on to in terms of how do you select those investments? In Michael, you started to talk about, that, and Tilly referenced as well, this kind of finding the needle in the haystack. What are the most important factors that you're looking for when you're deciding who to invest with? Tilly's talked about asset allocation at the highest level, but a very keen focus on bottom up and excellence of the investors actually managing the money. So Michael, maybe I can start with you since you started to go there already. What is it you're looking for when you're looking for a manager to invest alongside? What is it you're looking at? What are the qualities you're seeking? And describe that process for your team, and then we'll ask Jane and Tilly to chime in as well.
Yeah, happy to start addressing that. I think the initial response I would give may be a little bit surprising to those in the audience, in that it's far more qualitative than it is quantitative. A lot of the fund managers have been in business for a number of years, investing money, and the exercise is not simply, let's look at their track record. The one with the highest historical return must be really smart and successful, and we're just going to give them money. That would make our jobs very easy. But I think the qualification of past returns are not a guarantee of future returns is definitely a disclaimer that we take seriously. The environment in which those returns were generated might be different. The people around the table running the firm might be different. And there are a number of different circumstances that may not be indicative that what that firm was able to generate is going to come in the future. And so what we look for, I like to sort of frame it in three ways. One is a compelling, first and foremost, a high quality partner. So very often while we're picking investments here or underlying strategies, the quality of the partner, and that means their reputation, their integrity, their alignment, and a variety of different things that we can get into. But first and foremost, we're partnering with people. And while there might be a firm and a fund, it ultimately comes down to it's still a people business. And so who it is that we're partnering with matters first and foremost. Secondarily, a compelling strategy. So are they, have they found an interesting angle or approach to the particular investment strategy that they're pursuing? And then third, do they have the right team in place to execute on that strategy, and are they qualified to do so, either as a small investment firm, or do they have a large resource base with a lot of people to execute against that strategy? And so it really comes down to people, strategy, and the right team to be able to execute against that. And that's what we're looking for really across the globe. Our approach is generally looking for specialists, and I'll kind of wrap with this point, in that while there are firms that exist across the globe, Goldman Sachs, Morgan Stanley, JP Morgan, Blackstone, which may be familiar to some of those that are listening in, Fidelity, et cetera. Those are very, very large global institutional asset management firms. So they can, and typically will have, a number of different investment strategies in which folks like us can invest in, we typically shy away from those firms and we'll be looking for what we like to refer to as investment specialists. So they invest in a very narrow niche. So for example, pulling on Jane's example of the hotel in Miami, we may invest with a fund that just focuses on hotel properties, or perhaps even narrower band of resort type of hotel investments. Instead of investing in a global stock picking fund, we'll invest in a country specific fund. So we have a partner that invests exclusively in Indian public equities for us, and we'll replicate that across the globe. Like to say, it's hard enough to convince us you're good at one thing, let alone everything. And that's really sort of the mantra that we bring to our manager selection. So I'll pause there.
No, that's great. And I love that concept of specialization and trying to not be a jack of all trades, but focused in one particular area. Tilly, does that resonate with you? And in terms of what you're looking for in your managers and the types of managers that you're investing alongside? Oh, you're still on mute.
Sorry again. We have a very similar philosophy at a high level. I totally agree with Michael that, you know, it's really difficult to outperform, let's say, an index. And if you don't have a particular insight or a particular take on things, I mean, it's and the possibility of sort of sustainably generating really outsized investment returns is very hard to imagine. One other point that I might add, which I think will very much resonate with Anne-Marie, since I know it's important to you as well from our work together, is investment process. You know, how does the manager make investment decisions, and is that sort of repeatable? Because we want to know that, we want to look for signs that it hasn't just been by luck that they've generated whatever kind of good returns that they've had in the past. So how do they how systematic are they, and have they generally sort of been disciplined in terms of, you know, following a particular approach? So I think there's a lot there. Maybe it's interesting to talk a bit also about how do we find these managers, though, because
that would be great.
Everybody's
Definitely.
sort of on the hunt for things and I think, you know, many foundations, endowments, and family offices would, you know, share elements of what we've spoken about. And of course, we're being bombarded every day by people sort of wanting to raise money from us. So we have to be diligent in terms of sort of reviewing everything that comes our way and getting back to us. But it's a little bit like trying to join the club, and often, you know, that you don't want to join the club or something that sort of is soliciting your membership. So we're also much more likely, frankly, to find managers that we want to invest with by going out and actually looking for people, talking to others in our networks, maybe going to conferences, asking our existing managers who they respect in their strategy or their region. So it is a bit like sort of detective work, and we go through oftentimes very sort of wide screening processes that could actually incorporate speaking to tens, dozens, or even 100 groups before we finally alight on one that sort of meets our criteria.
That you're talking, it sounds like what you're saying is very similar to Michael in terms of very niche managers that are kind of hard to find. They aren't necessarily going to be big marquee names that everyone has heard about, or where there's advertisements out in the, you know, in the tube, for example. These are people that are
not necessarily. Michael and Jane probably heard about them, but
they're harder to unpick. And again, a very high emphasis, it sounds like, on the qualitative aspects of that partnership in terms of alignment and the integrity of the partners.
Absolutely.
Jane, can I come to you on this? And I'd love to ask your thoughts on, again, similarities or differences with what Michael and Tilly have referenced, but also how you're actually finding these managers, kind of drawing on Tilly's point of, you know, how do you find somebody that you don't know exists, and the role of in-person meetings and travel. And it would be great to just hear how you approach this as well.
Well, first of all, I'd say boringly, a very similar way to Tilly and Michael. We're looking for those same kind of managers. We're all out hunting for the same sort of thing. And I think hopefully what you're hearing is why this job is so interesting, because it's that mix of EQ and IQ. You have to read people. You have to try and understand, because you're basically looking at a manager and going, can I partner with you for the next decade and trust you to be a good fiduciary of our capital. So you have to do a lot of detective work to be confident that they're going to, do what they say they're going to do. So it's a really fascinating job. And yes, I mean, we source in a similar way. It's networking, it's talking to people. One angle is sometimes to go very early. So if you can find a manager, maybe there's a really fantastic partner at a firm and they want to spin out and set up on their own. Maybe that's someone you could back because you know them, you've followed them for a number of years and you know what they can do. And that's a fantastic way to sort of seed a new strategy with somebody who you know and trust and rate, and to get a good position in that fund. Because one of the things that we haven't mentioned on the way through is actually fees and economics matter too. How much you're paying to these managers matters. So if you can find a way to partner with a manager in a way that works for them, but also is cost effective for you, that's a win too. That's something to think about.
I think that's a really good point. And I think Michael did touch on it. I didn't ask him to unpick it, but that alignment concept of, are you aligned? And I think to draw on your point a little bit more though, Jane, seating somebody who's just starting up has got to be so hard. There might not necessarily be a track record that you can audit. How can you do that? Like, how can you actually say, here's a bunch of money, you're a brand new firm, I'm either never heard of you before. What does it look like? How do you do that?
That's very risky. A guy with a blank piece of paper and a great idea is very risky. But what's less risky is someone who has done this before somewhere else. And now, possibly with a partner who you also know, wants to set up on their own. And there you can see how alignment might be much higher than if they're at a big firm where they're a small cog and they're not really very incentivized. If two or more people are spinning out and setting up on their own, doing something similar, but are putting their own money in, so they're highly aligned with you, they really care about the success of the venture, and they have a track record that while it might not be entirely theirs, you can understand exactly what they did to create value. That might be enough to get you there. But you're completely right. It's a very high bar. That is not an easy investment decision, but it can be a very interesting one.
And Jane, I'm going to go back to Michael and draw on this a bit more, because Michael, all three of you have referenced this qualitative versus quantitative. Jane, you used EQ versus IQ, which I thought was brilliant. But Michael, you referenced the qualitative aspects in terms of the diligencing. Like if you're coming to a manager, like what Jane's describing, a brand new manager, or even an existing manager that you've never invested with before, how do you get comfortable with the qualitative? What are some of the things you might do? I mean, the quantitative seems relatively self-explanatory in terms of analysis, but I'd love to hear maybe how you do that. But describe the qualitative a bit more in terms of how you actually diligence that.
Yeah, there's no perfect science. There are some investors that have taken some of these behavioral kind of detective-like interrogation classes and things of that ilk. We don't really kind of put a lot of weight into that and haven't really pursued that. We've read books, it's interesting, but it's really through spending a lot of time with people, right? For us to get to know a manager, it's usually a many month, if not multi-year time process where we're getting to know someone. I can use the analogy perhaps as like dating and trying to find a spouse. Jane referenced partnering with someone for 10 plus years. It's a material commitment. And so first and foremost, while Zoom is a great medium and we've all become more proficient at it over the course of COVID, and it's created a lot of efficiencies, meeting with people in person is really a huge component and something that we truly value. We like meeting with folks both in our offices. They'll travel to us obviously as they're soliciting funds, but it's equally important for us to go visit their offices. And so what that will mean is spending obviously time with whoever the portfolio manager or managing director or founder of the firm is. Usually it's one person or perhaps two people or three that are partners, but it means meeting with the full team as well. So being able to be in their offices, and a part of our process, if we're more seriously looking at a fund and evaluating it, is meeting the full team and trying to understand and pick up cues as to why did you, questions that we'll ask people is, why did you join the firm? What's met your expectations? How is this different than the organization or firm that you worked at previously? We'll often have meetings where there might be a couple of people across the team sitting there together, and you can get a sense of how does the team work. If they say, oh, we're very collaborative and we work together, and that's the way that we come up with all these great investment ideas, and then you sit in a meeting and the portfolio manager dominates and speaks for 99% of the time and is cutting off their junior analysts who are trying to get in a word, that doesn't resonate, right? And there starts to be this disconnect, and that raises questions. So I think there is one component there of spending a lot of time. We'll also, even on occasion, we'll go to lunch with them, we'll spend time over dinner, we'll grab a drink and really try to understand who they are, not only as investors, but also as people, and what's really motivating them is what we're trying to get at. And then we'll also do work outside of direct dialogue with them through reference calls. And so very often managers, again, this is more of a later stage step within our diligence process, but they'll give us references like anyone would while they're applying for a job, and we'll call all those folks. But we'll also try and find people off the reference list, as the people on the reference list we would hope will only say good things, and that's why they're on the reference list. But LinkedIn is a powerful tool trying to look at the places where the individual worked previously and finding former colleagues to talk to, or otherwise, or perhaps people that have left the firm, and try and really understand and corroborate, as Tilly referenced, right? Is that investment process really what they say it is? Is that strategy, has it been consistently employed? What is it like working there, right? Human capital is so important within this type of an industry, and how do they treat their employees, and how do they retain their employees, and how are they compensating them, et cetera. And, if someone had left, why did you leave, right? Is there an issue there, or are they moving on to something within their career progression? And so that's an entire work stream that we do that tries to paint that qualitative picture that we're looking to really verify.
And I have to say, this is one area that really surprised me moving from being a portfolio manager to an allocator, is that how qualitative the work was. And Jane used the word detective work, and I do think it's a great way to put it. And I think it was one of the fun parts of the job, and something that not everybody will necessarily think of when they think of investment management. They might think investment management is number crunching and sitting behind a computer screen and working on spreadsheets all day long. And admittedly, there is some element of that in what all of you do, but so much of it is outward facing, talking to people, that human interaction. So it provides a lot of color and frankly fun to the job. It's been my experience. I'm going to pivot a little bit though, and I'm going to come back to Tilly and ask, when we're thinking, we've talked about long-term partnerships, we've talked about the alignment and integrity of the managers that you're investing alongside. I'd love to hear your thoughts on diversity and sustainability, and how important that is in your decision making and in terms of finding partners to work with.
Sure, it's really important part of our process. So we've set out an ambition for the endowment to reach a state of having net zero greenhouse gas emissions from its portfolio by 2038. And the reason for that, perhaps slightly odd sounding data, is that the Cambridge University has set out an ambition operationally to get to the same point in the same time frame. So what does that mean? It means that if you sort of added up all the shares of every individual company that we sort of own a bit of through our managers, that the sort of emissions associated with those small multitude of small ownership stakes would be net zero. And so it sounds like a long time in the future, but if you're committing to a partnership that might be sort of 10 to 12 year duration, as many of them are actually, it's not much beyond the end of that partnership where we need to be getting towards this point. So we are very vocal about this. We bring it up with fund managers early on in our conversations with them. We don't necessarily expect them to be very focused on emissions measurement and management at the outset of our relationship necessarily, just because since many of them are small boutiques, they might not have a very well-established sustainability team. They might not even have a dedicated person working on that at this point. But what we want to know is that they're open to working with us on this issue, and that they are committed to improving the, should we say, emissions intensity, or reducing indeed the emissions intensity of their portfolios over time. And it has been quite effective. So In 2022, only one of our private equity fund managers actually measured and reported greenhouse gas emissions at their portfolio level, whereas in 2023 it was at 9.
Wow.
So it still isn't the majority of our private equity managers, but it was a sort of 900% increase. So that was
great.
really interesting. And of course, what gets measured gets managed. So once people start measuring these things, then they start thinking, oh, well, maybe we can switch to renewable power sources to power our facility, or maybe we can replace our fleet with electric vehicles as they come up for replacement. It's any number of different things. So that's one thing that's really important. And then on the diversity front, obviously, as one of the founders of GAIN alongside Anne-Marie, and we're very passionate about diversity. And similarly, fund management isn't typically a very diverse industry, which is sort of one of the clearly motivating factors behind GAIN's mission. But again, if we can bend the arc of a firm's development and encourage them to really think deeply about the backgrounds and the types of people that they're adding to their team over time, we feel like we can make a real difference. So we, again, talk about that, talk about recruiting strategies, talk about how the team's career development is organized and planned, and so on. And also, very importantly, as Michael mentioned, we'll talk about why people might have left, and sometimes that can point towards cultural and other issues that may or may not be concerning. So yeah, we're very focused on those things, and we find it typically leads to very rewarding conversations with managers. And it's, as Michael said, we try to sort of build up a complete picture of these organizations. So it's actually really helpful to kind of come at them from different standpoints and see how they react and evaluate the quality of their thought process in different contexts.
No, it's super, super helpful and really interesting. Jane, I'd love to ask you the same question in terms of sustainability and diversity, in terms of, in terms of its role in your day-to-day decision making, and how you guys think about it at Wayborn.
Yes, we think about it a little differently, because as a family office, the key consideration for us is reputation. The family's name is on every product that goes out of the Dyson business. And so we can't invest in something that is going to contaminate the firm and the brand. So as an example, you might find a really interesting fund that invests in distressed residential mortgages and repositions them by booting people out of their homes onto the street, right? So for us, that's not a strategy we would ever invest in. It might be very lucrative, might make a fantastic amount of money for you, but reputationally, it's just not the right thing to do. So that's our filter, which in some ways is broader than Tilly's, and it's obviously less specific and more subjective, but it means that we care about many of the same things. And diversity is really interesting. I mean, it is, as Tilly says, a startlingly non-diverse industry. We have a very diverse team, slightly accidentally, here at Wayborn, and just the diversity of thought that generates, and the kind of environment that you work in, it's a tangible benefit that you get from that. So no, we absolutely encourage that in our managers, but it's a nudge rather than a push.
Yeah, no, really interesting. I think you're talking about like that kind of sustainability in the broadest sense of the term, in terms of reputational and partnership. And I know Tilly's team at Cambridge is also very focused with an 800-year-old university. Long-term reputation is, again, super important. Michael, I'm assuming that there's going to be a lot of alignment here, but I'd love to ask you the same question in terms of how does sustainability and diversity, or sustainability in the broadest sense, or in terms of ESG or the E or the G or whatever part of it, how does that feed into your investment process?
Yeah, I think there are a lot of similarities, and obviously there are some distinctions and differences. The foundation at this point in time doesn't have sort of an explicit target or date the way that Tilly has within her investment mandate, given the various stakeholders and constituencies that she has. But it is something that is top of mind as we engage with our managers, right? You can come to conclusions or sort of, an ambition on environmental sustainability from a values perspective, and simply something that you believe in, but it also you can arrive at certain conclusions and considerations based on a business case, right? And I think sustainability truly becomes sustainable and these environmental considerations when those two blend, right? When it becomes cost effective and it becomes, better for the environment and also better for business on the bottom line. Sometimes that's stimulated by government incentives or regulation, but ultimately, hopefully, gets there. And so anytime we talk to any of our managers, especially if they're investing in a way that may have an environmental impact, which all businesses do to some degree, but some of them are more intensive there. It's something that we talk about and have considerations. And we're seeing an increase within our fund managers having either dedicated staff or teams that are tracking, managing, and thinking about ESG considerations. And it's become part of their underwriting process in terms of the way that they think about any of their investments within their strategy. Shifting towards the diversity part, the DEI and diversity has become an increasingly, over the last number of years, important topic across the United States, given kind of events and sort of the environment here. And likewise, the foundation has really embraced a diversity push even prior to that across all of our work. And so that's not just within the investment portfolio, but that's in the way that we grant money and the organizations that we're granting money to, thinking about who is the best person to be serving the populations that we're serving, a push really from less sort of national large organizations to more locally led organizations, sort of the boots on the ground approach. And then within the investment portfolio, we're mindful of, who are the people sitting around the table. And very much to Jane's point, we truly believe that diversity of thought and diversity of experience will create a richer team to be able to potentially have more success on the investment front. And so that's something like Tilly and Jane, we engage in discussion and engage our managers to understand how they're building out their team, where they're recruiting, and how they're trying to sort of, make the most of the human capital that they have within their firms. And likewise, within the foundation, we're a small team. I don't think we've touched on this yet before, but we're, depending on the year and the way that sort of our team is structured, we're no more than 10 people on the investment side. And so we don't hire hundreds of people a year or have investment banking classes or consulting classes of dozens, if not more people. But we do have a dedicated internship where we've partnered with a group like Gain here in the States that we hire an intern each year and sort of provide an opportunity for individuals to sort of explore a career path that may not have been afforded to them. And then we partnered with other groups, one in particular, like Gain, where one of my colleagues taught a class to high school aged young women to sort of stimulate their interest and provide opportunities for them to consider a career in finance. And so I think when it comes to this topic, I don't think any one firm or one investor can sort of change and single-handedly kind of diversify what historically hasn't been a very diverse industry. But I think if each institution is sort of doing their part and engaging in a constructive way, that's the way we'll make a long-term difference.
No, great. I love that you're getting involved. What you're bringing into the conversation is not just the diversity in the investment process, but actually the impact of what you're doing outside the organization. So thank you for going there. We're wrapping up the hour, and as we kind of round things out, I did want to ask some more career advice questions to the three of you. And maybe if I can start with Jane, I'd love to ask you just, if you had, if I were to ask you, what was the best piece of career advice somebody gave you over the course of your career? What was it, and why was it so impactful for you?
Actually, funnily, I think it was something that I heard at one of my daughter's career advice talks, which was the job that you're doing in 10 or 20 years' time might not even exist today. From which I took, you've got to stay flexible. AI is definitely, for example, going to change the way that we do our job. You've got to stay intellectually curious. You've got to stay flexible and engaged and go where the opportunities take you. So you may be fortunate enough to have a 10-year vision or a 20-year vision of what you want your career to look like. Fantastic. Good luck. I didn't have that. And, I think that a career path can take many routes and bring you to some really interesting places. So stay flexible. That'd be my advice.
No, great. And Tilly, you followed a similarly non-traditional path, I'd love to ask the same question of you, the best career advice you've received, or you've heard it at a talk. I'd
Sure.
love
Well,
to
it sounds
hear
like
that.
Jane and I had a very similar path. So maybe we can start a new tradition. It's like we both worked in consulting and private equity and then came into these types of roles. But I think it's maybe a slightly different take on the same point that Jay made. I mean, I didn't have a great deal of career advice, which may explain why it took me so long to get into this job. But I would say that when I meet young people today, young women in particular, I think people often feel very stressed about, what job are they going to choose for their first job, and maybe they don't know, or they're not quite sure what they want to do. And I think my main advice would just be to say, it's okay. Like, how are you supposed to know what you want to do? Because you haven't started your career yet. So it's really almost impossible to know exactly what's going to interest you, because it might be very different from what you've been doing academically. So I would say, don't obviously be thoughtful about the role that the first role that you take, but at the end of the day, you can always make a change. And that goes back to what Jane was saying, that you'll actually learn more by doing something, even if it turns out not to be the wrong job for you, because by just doing it, first of all, you'll learn interesting and useful skills, but you'll also learn what you enjoy professionally, what you don't enjoy professionally, what you're good at professionally, what may be less strong points for you. And obviously for me, writing essays about Shakespeare is not something I've never used subsequently. So I had to sort of start completely from scratch. And so everything I've just picked up along the way, but I just followed my interests. So I just followed the things that I thought, well, I'm interested in that, so I'll do it. And as a result, it sort of ended up taking me towards something where I like pretty much everything that I do.
No, great. And Michael, I will come back to you, Tilly, but Michael, I had the same question, best career advice you've received or career advice you'd give to your younger self.
I think one thing that I'll mention to folks, and I agree with everything that's been mentioned, is don't necessarily focus on, what is my career path. Again, it's impossible to sort of chart that so early on in one's career, but in that first job or first couple of jobs, think about taking a position where you're going to learn, right? And it might even not be about the firm, it might be about the team or the specific group that you're joining, and make sure they're committed to mentoring, to training, because it's those skills and those opportunities and the self-reflection and that learning that you'll be able to capitalize and take with you, that Tilly reference. And so sometimes while just getting a job is exciting in and of itself, if you do have the ability to sort of focus your attention on a search, or perhaps even entertain competing offers or pathways, thinking about a type of role and the type of firm and the group that you might be placed in, and what you're going to learn there, I think is really, really important, versus just sort of getting the job or nailing the right industry that you want to be in, because I think it likely isn't going to be the one that you stick with. So you want to be able to make sure you maximize your time there to be able to then take those skills that you've learned with you to whatever your next step is.
I think that's fantastic advice. Someone once said to me a long time ago, go somewhere where somebody's going to invest behind your career, not just behind their own career, but behind your career. And I had the great privilege of working with Tilly for 3 years. So Tilly, I'm actually going to come back to you because you did invest tremendously behind my personal career. And if I wanted to draw on just to unpick that point that you made a little bit earlier in terms of people might not know much about what you do. If they wanted to find out a little bit more, what would you suggest that they do?
In terms of the role of, being an
allocator. Yes,
foundational
exactly.
family office investor. That's an interesting one. I mean, obviously Gain has a lot of resources on the website, also on the YouTube channel. There are lots of both live and sort of pre-recorded webinars on different investment topics. There are also tons of really great podcasts out there. So there's one called Capital Allocators, with Ted Seides, where he interviews tons of both endowment, foundation, family office managers, and also fund managers who run specific investment strategies. So that's one of the ones I'm always listening to when I go running or walking the dog. And then there's one called Invest Like the Best with Patrick O'Shaughnessy, which is a little bit similar, although it's become a bit more tech focused, but similarly has a lot of interviews. And to have a look around on the podcast, that would probably be my number one tip. They're very accessible, and it's also fun to learn a bit more about the people behind these strategies and businesses, as well as the more technical aspects of what they do.
Yep, no, great. And I think we always recommend to people who are interested in coming into the allocator space that they do read Pioneering Portfolio Management by David Svensson, which is frankly the Bible for most allocators. It's a tiny bit dry, but it's a fantastic resource. I think is a great place to
Very
start.
true. That's a great book to read.
Jane, I'm going to wrap up with you, and I'm going to ask you if someone has decided that being an allocator with an endowment or foundation is actually what they want to do, and they've secured an interview with someone such as Wayborn Partners. What are the key 3 or 4 questions you'd ask them, or you'd suggest that they be asking to find out more, or to learn whether it is the right fit for them?
It's a good question. I think maybe we can all throw an idea in, but I mean, I think you want to know where the money's coming from for a family office. Is this a family you want to be associated with? That's one thing I would really care about, or an endowment. What's the purpose of this endowment? Do I want to support this? Because that helps. I think you want to understand who's involved in investment decision making, because lots of organizations like ours can get very bogged down with complicated decision making that may not lead to the most rational way of arriving at investment decisions. So you want something that's very clear and where you can understand how investment decisions are arrived at. And actually, to Michael's point, how big is the team and what's my career path going to look like? I think is a good one, because all of us work as part of quite small teams. So how are you going to develop my career is a good question to ask, because it shows that you care about developing your career, but also you want to know the answer to that one. So those would be a 3 starter for 10. I'd throw those in.
Great. Tilly, Michael, anything you'd like to add? Tilly?
I can hop in with one. I think I think everyone on this screen did not do direct investing. There are, I think, some family office more so than perhaps others, but there are some organizations that do direct investing. So asking and really clarifying, is it truly an allocator role where you're picking fund managers, or do you do any direct investing in-house, would be an interesting distinction. And then along the lines of team construction, our team is generalists, and so we've referenced over the course of our conversation a lot of different investment opportunities across the globe and asset classes. Our team, everyone on the team has a chance to work across the full portfolio, which I think is particularly interesting and rewarding, and you get a chance to learn a lot. It's kind of a much wider purview than going very deep. That's, I think, very helpful, in particular in the beginning of one's career. So asking, is the role I'm interviewing for a specialized role where I'm just going to do private equity or just public equities, or even a more refined sort of narrow slice of the portfolio, or is it a more generalist role, is an interesting thing for someone who's interviewing for a position to ask, because every institution and investment team is structured slightly differently.
That's great. That's a great question. Tilly?
I think those are all really terrific questions. I think if you are interviewing for a role and you meet another analyst or associate, I would definitely ask them sort of just to describe a day in their life. Of course, there may not be one typical day, but just that will elicit lots of interesting information, and you can probe further on points that particularly sort of stand out. And I think if you don't meet an analyst or associate, or somebody who's going to be a near peer of yours in the process, and you get far along in the process, I would definitely ask to meet somebody, even if it's just informally for a coffee, because you want to meet your peers and just understand a bit about how they've experienced the organization, and and have a chance to ask them about their role.
Those are all fantastic questions. Thank you all. I think we are at the top of the hour, or very close to the time we need to wrap up. So I'm going to draw things to a conclusion here. I did want to say a huge thank you to our 3 panelists. Michael, Jane, Tilly, thank you so much for your incredible insights and sharing what you do. I hope our listeners found it as interesting and informative as I did. I enjoyed it tremendously. So thank you all very much. If anything sounds of interest to our audience and they want to find out more, I would strongly recommend that you go to our website, gainuk.org. And I would also follow our social media channels, so LinkedIn and Instagram in particular, where we share updates, inspiration, and work resources. on a regular basis. So with that, a huge thanks to our panelists, a huge thanks to our listeners, and we hope to see you all again soon. Thank you so much.
Thank you, Anne-Marie, for being such a great moderator. Thanks,
Thanks,
everyone.
guys.
Cool.
Bye.
Thank you, everyone. Bye.